We are about to end a rather easy week, yet in the next one, the markets may find some surprises. Let's have a look at what next week has in store for the markets. On the monetary front, we highlight the release of the Fed's November meeting minutes on Wednesday. At this point, we also note that we get from New Zealand RBNZ's interest rate decision on Wednesday, and on Thursday from Turkey CBTs and from Sweden Riksbank's interest rate decisions. Also, a high number of policymakers from various central banks are scheduled to make statements and could shift the market's mood. As for financial releases on Monday, we get New Zealand's trade data for October, and on Tuesday we note Canada's retail sales for September and Eurozone's preliminary consumer sentiment indicator for November. On Wednesday, we note the release of November's preliminary PMI figures for Australia, Germany, France, the Eurozone, UK and the US. While from the US, we also get the durable goods orders growth rates for October, the weekly initial jobless claims figure, and the final University of Michigan consumer sentiment for November. On Thursday, we get Japan's preliminary manufacturing PMI figure, Germany's IFO indicators, and UK CBI industrial orders trends, all being for November. While on Friday, we note the release from Japan of Tokyo's CPI rates. The USD seems to have stabilized after the shocking losses of the week before, and currently maintains a range-bound movement. On the monetary front, a number of comments made by Fed policymakers after the release of the US CPI rates for October that showed that inflationary pressures seem to be easing, indicated that Fed policymakers may feel more comfortable if the central bank slows its rate hiking path. On the other hand, other Fed policymakers implied that the bank's monetary policy tightening failed to substantially dent inflation and are calling for more rate hikes. So there is still some ambiguity about the Fed's intentions. Hence, we highlight the release of the Fed's meeting minutes next Wednesday. On a more fundamental level, the midterm elections have ruled a Republican majority in the House of Representatives, something that would provide a political gridlock in the US government and curtail the fiscal plans of the White House. The pound is about to end the week high against the US dollar, yet seems to be gaining ground also against the euro and JPY. Inflationary pressures are rising in the UK economy as October's headline CPI rate accelerated beyond market expectations, reaching 11.1% year-on-year. The acceleration of the CPI rate is expected to increase the pressure on BOE to tighten its monetary policy at a fast pace. Yet on a fiscal level, we note that Jeremy Hunt's autumn statement tended to signal the return to conservative orthodox economic theory. As was expected, the UK's finance minister announced tax hikes both on a personal level as well as on a business level, and at the same time, fiscal spending discipline is planned. Overall, the announcement, especially on the expenditure side, seems to have a weak point, as the measures may prove insufficient to tame inflationary pressures in the UK economy, something that may intensify the efforts of BOE in that front on a monetary policy level. JPY is about to end the week weaker against the US dollar, euro and the GBP in a sign of a wider weakness. Overall, BOJ's dovish monetary policy tended to enhance the bearish tendencies for JPY on a fundamental level. We note that Japan's preliminary GDP rate for Q3 dropped into the negatives, taking markets by surprise, revealing that the situation in the land of the rising sun is worse than what was expected. The drop as such tended to provide more leeway for BOJ to maintain its dovish stance in place. It was characteristic that during Thursday's Asian session, BOJ Governor Kuroda reiterated the bank's intentions to maintain its ultra-loose monetary policy in order to support the delicate economy. BOJ remains an exception among other central banks, yet the acceleration of CPI rates for October to multi-year highs tended to increase the pressure on the Japanese central bank for an exit strategy from its huge quantitative easing program. Euro is about to end the week at the same levels it began against the US dollar, is losing ground against the pound and seems to be gaining against the JPY. On a monetary level, the ECB seems to be determined to do whatever is necessary to get inflation back to 2%, as per ECB's Vice President Luis de Guido's comments. In the bank's financial stability review, the bank warned that financial stability risks have risen, given the high inflation, the weak economic outlook, and the tighter financial conditions, which in turn may increase borrowing costs substantially. Yet the bank is expected to continue tightening its monetary policy, possibly announcing a quantitative tightening in the December meeting. Furthermore, the situation seems to remain dire. Worries for a possible recession are still high, with economic activity being in the epicenter of attention. Hence, we highlight the release of the preliminary PMI figures for November due out on Wednesday. AUD is about to end the week stable against the US dollar. Fundamentally, the Aussie as a commodity currency is sensitive to the general market sentiment, and an improvement tends to provide support for AUD and vice versa. On a monetary level, we note that the release of RBA's November meeting minutes tended to pass relatively unnoticed. Yet we have to note that the better than expected employment data for October, given that the employment change figure rose and the unemployment rate dropped, implying an even tighter employment market, provided little support for the Aussie. On the other hand, the close trading ties between China and Australia force us to keep an eye out also for developments in China. The slowdown of China's industrial output growth rate and the contraction noted in the retail sales could also be spelling trouble for the Australian export sector. The partial reopening of China, as announced last week, seems to be reversed as there was a recent rise of COVID cases in China. The CAD is about to end the week weaker against the US dollar. On a monetary front, BOC's Governor Tiff Macklem seems to remain adamant regarding the curbing of inflationary pressures in the Canadian economy. Inflationary pressures are still present as the headline CPI rate failed to slow down for October, remaining unchanged at 6.9% year-on-year, while the core rate seems also to remain stubbornly high. Yet the effects of BOC's tightening seem to become more evident as news in the construction sector were not as good as economic activity seems to be dropping. On a more fundamental level, we expect the loonie to remain sensitive to the general market sentiment, and a deterioration could weaken the commodity currency and vice versa. Also, the drop of WTI prices does not bode well for the CAD, given that oil is one of the main export products of Canada, and a further drop could weaken the Canadian currency. In the coming week, we note that the market's attention may remain divided among different currencies, given that high-impact financial releases are to stem from various countries. The heavy point, though, may be USD-based, as it may be the release of the Fed's meeting minutes. Furthermore, Wednesday is expected to be especially busy, as we also get the preliminary PMI figures from a number of countries for November. Hence, we expect the more balanced blend of trading opportunities to be maintained in the FX market. In the US stock markets, despite there being a number of companies that are due out to release their earnings reports, that number is considerably reduced, thus we may see some interest shifting away from US equity markets. As for the precious metal, as noted in the last report, the negative correlation with the US dollar was on display once again, something that we expect to be maintained in the coming week as well. We hope that you found this report useful. From all of us here at IronFX, best wishes for solid trading.
And welcome to another video. Today we'll be looking at take profit orders. This type of order is a type of pending order that is used to realize the profit when the price reaches a certain level. The execution of this order results in the closing of an open position at a specified market price. The purpose of take profit orders is to look in any incurred profits. For example, a trader enters a buy position expecting prices to go higher. In order to benefit from the rise, he will place a take profit order at a level higher than the entry price. If the bid price reaches the predefined take profit price, the position is closed and any profits are locked in. If a trader enters a sell position expecting prices to fall, he will place take profit order at a lower level than the entry price in order to benefit from the fall. If the ask price reaches the predefined take profit price, the position is closed and any profits are locked in. The benefit of using a take profit order is that traders don't have to worry about manually executing a trade. Take profit orders are executed all the best possible price regardless of the behavior of the underlying asset.
Thank you guys for tuning in, right, on today's session on trade management, take profit, and stop loss placement. So I'm sure every one of us who are trading will want to know where's a good point to take your profit and where's a good point to take your stop loss, right? Because most of the time we know that sometimes it happens because it hits our stop loss and then flies to our take profit. So it's slightly a bit more frustrating when that happens. So in this session, I'm hoping that I can explain some of the methods that we use to place take profit levels and stop loss levels as well, right? To redefine or to define more specifically where you should put them so that you can take better profits. Okay, so today on IronFX, before we start, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. And before I start, right, maybe let me just bring you guys let me do a short introduction on some important websites that you guys should know, right, before I start the webinar. So on IronFX itself, if let's say you tune in later today and you miss out some parts of this session, you can go to our webinars, right? And you can go to, wait, let me see. I think you should be here. Okay, you should go to the webinar site. It usually should be here. Give me 1 second. Okay, platforms. Okay, we do record our webinars and our podcasts on the page itself. So you can come in to see all the past webinars that we have recorded. Okay, past webinars. Click here. If you miss any of the webinars and you want to have a refresher course, right? So if you want to listen to any of our English webinars, click on the English and then you have all the past webinars that we have recorded here, right? Like our live trading session, our fundamental analysis, previous sessions on the Fibonacci. If you wanna take a look, yeah, it's all here. Okay, and I want to as well as tell you guys about our special VIP room, right? Especially for all the IronFX clients that we have. So in this VIP room, you have exclusive market forecasts. Okay, we will be posting some of our analysis from our prop traders as well as Desmond himself, right? So you can ask our experts anytime. I will show you guys how it works later on. So this is just a page to bring you through and as well as let you know where to register, right? So you can let us know what currency pairs or if you have any questions, we'll be live to answer, right? We'll be there to answer you. Okay. So there are different premium services, different 5 tailored account types for you to choose from. So if you are already a member of the IronFX, you just have to deposit the sum to get you to different tailored account types, right? Okay, so you just click on this link here, access our VIP room. I'll paste the link here. Right, let me just paste the link here for everyone to see. Okay, just click on that link and you should be able to sign up. Okay. Okay, so this is how the VIP portal looks like, right? You have a section where you can chit chat with us. If let's say you have some questions about maybe different currency pairs, or where are some of our key levels, or where we should be looking at, right? Chit chat. Okay, and every day we will have news that we post, updated news or daily news, important news that we post here. Okay, the majors, your DXY, your Euro, your USD pairs, commodities, indices, crypto even. Yeah, so any currency pairs that you need, it will be here as reflected. So how do we actually use this VIP portal? So for example, we are looking at Euro USD, right? So, okay, just give the chart a minute to load, okay? So it will be this chart that you see, and then there will be all the tools that you require. For example, your Fibonacci, you can draw, and then you can type here, okay, hi, Annabelle, is that important reversal point? For example, if you're looking at, okay, for example, if you're looking at this level here, let's see. Okay, so for example, if you're asking whether this is a key reversal area at the 38.2%, you can highlight, right, and link to this line, confirm, and you enter. So every time you post a question, we'll be able to see right here where exactly you're talking about, right? So you can toggle around, let us know if you have any questions about any currency pairs, right? It's very useful, it's very tailored service. So yeah, check it out. Okay, and okay, so that's all before I start the session. So let's, without further ado, let's just start the session. Okay, so that's me. I work for the Everest Fortune Group, right, which run the award-winning research firm finalist for Best FX Research 2019, 2020, 2021, and the finalist for Best Equity Research 2020, 2021. Okay, so the agenda for today will be talking about why stop loss and take profits are important. Why is it important to set both of them? Okay, both of them are as important, right? Your stop loss as well as your take profit levels, right? Why they are important. Okay, the anatomy of a trade, okay, is not only just about your entry, it's not only about your stop loss and placement. There are other factors as well affecting the trade, right? Fixed stop loss and take profits, why are they not that ideal? Okay, dynamic take profit and stop loss placement. So we'll be teaching you how to make it a more dynamic way of placing your take profit and stop loss, right? Risk allocation, what is the ideal lot size, or what is an ideal percentage to set aside, right? This will be covered during today's session. So before I start, just to let you guys know, if you have any question, please feel free to post on the comment section, because I can see exactly, yep, I can see exactly on my left side of the screen, right? So if you have any question, just let me know. Okay. So why is it important to place stop loss and take profit? So maybe I ask the audience a question. So do you guys actually place stop loss and take profit levels, or you just let the trade run on its own? So you can be honest, because most times I have seen people who just enter a trade because they feel like, they feel like their guts tell them, or maybe some of the support key resistance level tell them that it's going in a certain direction, but they have never actually thought of how much profit or how much stop loss they should put in every trade. So how many of you guys actually play stop loss and take profit levels? Let me know. Joachim, what about beginners? Yeah, actually even for beginners, it is a good habit to put all stop loss and take profit levels. It's important, right? I have some answers. I use them. It's important. Sometimes I put, but mostly it hit stop loss. I mean, that happens to most of us, but you still have to put because it's about risk management, right, Dipesh? Okay, so the reason why you have to put your stop loss and take profit levels is because number one, of risk management, right? Managing stop loss and take profit help you to manage your trades more strategically, right? Instead of more emotional kind of trade, right? You strategize your trades, like how much stop loss and how much take profit is worth the time and aim and effort, or worth that risk for you to take. So risk management, what I mean by that is how to properly identify these values are important, because you need to know, identify your favorable opportunities and come to term or accept the level of risk that comes with it. So with proper use of stop loss and take profit levels can play a crucial role in preserving and growing your portfolio, right? Not only are you like systematically protecting your holdings by prioritizing less risky trades, but you also prevent your portfolio from being wiped out completely. Okay, so that's what I mean by you can identify and analyze properly before you enter a trade, right? Instead of just enter and then you think about your stop loss later. Okay. Number two, prevent emotional trading. So some of us, when you trade, you get slightly more emotional. So when you have stop loss and take profit levels, it's sort of like your boundaries, a set of discipline, right? To prevent yourself from getting the account wiped out, right? Because a lot of us, we trade because of impulse or on impulse. So this is why some traders rely on a preset strategy to avoid trading under stress or fear or greed, right? Because these are very powerful emotions. So you do not want to impulse trade. Hence, you set your stop loss and take profit levels accordingly. And the last point, which is the most important point, right? It is very important to know whether your risk to reward is rational, or whether it's logical to calculate your risk to reward. You can't be risking $100 just to win a $10 trade, right? It just doesn't make sense. Okay, so your risk to reward has to be rational, okay, before you even take a trade at all. Hence the importance of stop loss and take profit levels. Okay, so some of the methods used to calculate stop loss and take profit levels. Number one, trend lines and support resistance levels. So support and resistance are core concepts familiar to any technical traders or any traders at all. These are the areas where price chart are more likely to experience increased trading activities, because as prices come to your support or your resistance, these are the key areas where most of the trading activity will happen, right? This is where the fight always happens. Okay, so be it buying or selling. Hence, traders who use this method typically set their take profit level just above the support level and stop loss right below the resistance level, they have identified. Okay, so if you are taking profit, you should take slightly lower, because you don't want to come here. When prices come here, they will fight, and it's very messy. You don't want to miss out like maybe 80% of your profit already. So usually for take profit wise, we will set it slightly lower, and if it's a stop loss, you want to set it slightly below, because you want to have some buffer. Okay, percentage method. Okay, this is useful as well. So instead of a pre-specified level calculated using technical indicators, some traders actually use a fixed percentage to determine their stop loss and take profit. So for example, if you want to close a position at maybe 5% of your 5% gain or 5% loss. So it's depending on what is your RR, what's your ratio of your risk to reward, right? How much you want to take. Okay, this is quite straightforward. And the last point would be moving averages and other indicators. So some traders, they monitor moving average closely, looking out for opportunities to buy or sell presented in a crossover signal. For example, like your RSI or your MACD, right? So they'll set a percentage or an amount of pips, like maybe 10 pips, take profit or stop loss. Okay, so these are some methods that traders use. For Omar, what is the recommended RR rate? I will come to that later. Okay, for different people, I mean, there are different reasons for different RR rate. Okay, so the anatomy of a trade. Okay, so a lot, like I've mentioned before, most of us, we actually enter a trade. When we do an entry, we forget all about our stop loss and take profit. Because, for example, if I see a market moving in a ascending trend line, I will be very nervous, or I want to catch the wave, right? So I will just enter without thinking. I'll just enter right here, or maybe here. It's a good level. There's a breakout and I urgently need to enter. I just enter a trade without thinking of what is my stop loss and what is my take profit, just because I want to be part of this action, correct? That is very risky. Okay, so we check off all the boxes. For example, our Ichimoku, we check off our trend lines, our breakout levels, but stop loss and take profit comes only after execution most of the time. So all this take profit and entry, take profit, stop loss are all as important. Okay, so anatomy of trade, there is entry, stop loss, take profit. Not only these three, there is also your break even point, your partial profit, right? Your idea invalidation, and cancel trade. These are all as important consideration. Oops. So the anatomy of trade includes all this, not just an entry only, right? So the rest of this will be covered in the rest of the webinars following trade management part 2, 3, 4, right? Okay, so remember, it's not only just entry, stop loss, and take profit, okay? All are as important. Okay, so now let's talk about how we take profit and place stop loss in the most simple manner, most logical and simple manner, okay? So usually when a trend comes along, right, you will have to identify your major resistance area and your major support area, correct? And these levels here are called the magnetic. They are the magnetic areas because prices tend to be very attracted to them. Okay, so for example, when your price is moving up, should your take profit be exactly at the line here? Should your take profit be here? Or should your take profit, okay, let me just draw. Should your take profit be A, or should your take profit be B? Can't see my chart. Are you guys looking at my chart? I'm not. Let me know in the comments if you guys can see what I'm sharing. Can you guys see here? Okay. Okay, then maybe Terence, there's something wrong with your screen because, yeah, okay. Okay, so let me know whether your take profit should be at A or should it be at B. If let's say my trend is going this way, my trade is this way. Okay, I can see some answers. There are some A's, there are some B's, but the answer is none. Because if you are looking at taking profits, right, what you should be doing actually is point C. Yes, it should be before A, correct. Okay, because once it hits this level, there will be a lot of commotion going on, all the fighting, all the fights will be happening here. So usually I just want to avoid that. I will take my 90% and run off, right? Just leave the 10%, it's okay. Because you do not want a point to happen where just because for the 10% you wait for price to almost reach there, reverse, here you panic. You don't know whether you want to sell or you want to hold, correct? And then you hold, thinking that it will come back, bounce back, but nope, it went back down 50%, gone. So instead of taking 90, you take 50%. Okay, so usually take profit levels should be below the resistance or magnetic area. And for your stop loss, it should be slightly after, okay, because you want to have some buffer, correct? Okay, so what's some problem with fixed stop loss and take profit? Anyone else? So you know, some channels, they tell you that if your moving averages cross, you can actually place a trade to take 100, okay, let's say 10 pips above, and then place your stop loss 10 pips below. Okay, any idea why this is not the best or not the most ideal way of taking profit and placing stop loss? Okay, the reason why it's not good, although it's a disciplined way of taking profit and placing stop loss, it's not ideal because, like I've mentioned, most times prices will react to a certain point and reverse. So you don't want to be caught in a situation where you are like maybe at a 9 pips and then you are very rigid, or you just want to hit the full 10 pips and then it reverses, you panic, right? You don't want to be caught in a situation here. So that's the problem with your stop loss, fixed stop loss and take profit levels. Okay, so let's go to some examples. Okay, so this is the support level here that we are looking at because you have 2 points. Okay, so this kind of looks like a double bottom, right? So prices are always very attracted to key levels before a bounce off. Okay, so number one, nice support level here, nice. Okay, so here, because there's a breakout, we buy thinking that price will go up all the way. Okay, strategy has a fixed stop loss of 100 pips, which is all the way down here. Okay, this is my stop loss, which is right above. Okay, and then instead of going up, my price came down, touch my stop loss, right? Because it's 100 pips, right? Because my mentor told me it has to be 100 pips. So I fixed to 100 pips. Okay, so I stick to it. But it's tap out, hit my stop loss, and then it reverse in a direction. Actually, there's another slide that shows that it flew back to my take profit levels. Okay, so my point here being, since you know that your prices are always very attracted to your key magnetic levels or key levels, you should always place your stop loss slightly below these key levels to give it a buffer, right? So prices actually touch here and flew back to my take profit. Okay, take profit should be also slightly below because you don't want to wait until you hit the important level and then the fight begins. Okay, you don't want to be caught in a crossfire. Okay, so in essence, when prices goes near the resistance, you should take profit before any commotion happen. This is the red zone. Okay. And then if you're coming back down where your stop loss is, you always give some buffer instead of placing it exactly at the crossfire area. Okay, it doesn't make sense. Okay, so another example. So here is clearly a strong resistance area where price has reacted off twice. As you can see here, bounce off once, bounce off twice. So if let's say you have a fixed 100 pips, which like I've mentioned, your mentor or someone actually tell you, you should set it to this because of your simple moving average crossing, whatever it is. And then you stick to your 100 pips, which is here, take profit. Your price actually bounced off. This is what you get originally, 90%. 90% profit. But instead of this small gap here that you are waiting for it to touch, hoping that you'll come here, for the 10%, you actually miss the whole trade, right? So point being, always place take profits below, slightly below the key resistance area, okay? So if you place your take profit slightly before the key resistance level, you would have been in a 90% take profit trade, right? So lesson here is don't blindly follow a fixed take profit target just because some foreign told you to. Although I think it's good discipline to set a fixed take profit and stop loss, but you should also act according to what the charts or what the market is actually reflecting to you, right? You don't want to be rigidly sticking to your 100% or 100 pips take profit, okay? So take profit placements the wrong way. Now here is the swing high, previous swing high, which is a major key resistance level. Okay, bought and have a long position this way. Okay, price reverse before the big resistance here. So if you would have set your take profit slightly lower, you would have made maybe a 99%. Okay, always place your take profit before key resistance and support, right? Okay. Oh, so this is the same example as I've done before, right? Nice support level. You think your price will go up, and then the stop loss is here. Hit your stop loss and fly up. So this is the same exact example that I have done before. Okay, what I mean by dynamic take profit placement. So maybe you guys can share with me how you take, what are some of the methods you actually do your take profit levels? How do you place where you do your, where you take profit? Like, do you go by your risk to reward? Do you go by a ratio? And often do you actually change your take profit levels? Do you adjust them? Let me know in the comment section. Okay, yeah, it's very common for people to use the risk to reward. What are your risk to rewards then? I'm curious. So some people risk to reward will be 1 to 2, but usually that is quite hard to achieve. So unless you are scalpers, usually I don't think they might use the 1 to 2 because price fluctuates too fast. Okay, risk to reward and next psychological level. That's interesting. 1 to 1. 1 to 1 could work for scalpers. Okay, so what I mean by dynamic take profit placement. Okay, let's see. So as some of you have learned, in this section, I will just use Fibonacci as a easier way to explain what I mean by dynamic take profit. Okay, so right here in the chart, we can see, okay, the entry level. So if you are looking at a short position, your entry is here, your stop loss is placed here, right? So we enter a position here. Okay, prices actually came down. Right? Came down here. This is our by right a take profit level that we are looking at. Okay. But let's say prices actually, once you draw your, this is a, let me see. Okay, this is a 78.6% retracement because they draw here, right? So this is a retracement level. Okay. Oh, okay, wait. Sorry, let me re-explain this. Okay, I think what they meant here is, okay, so my Fibonacci is drawn here, correct? And then I'm looking to enter a position once it hits my Fibonacci level here, because usually price tends to reverse at these levels of retracement. So I'm waiting for an entry before the short position and my take profit being placed here. So point 1, my stop loss should be placed above the highest, slightly above or below the highest or the lowest point, right? Depending on whether you're long or short, okay? So you always need to have some buffer, okay, for your stop loss. And then point 2, if your stop loss, if your take profit level is here, maybe you want to take slightly before instead of exactly at the point, because John cannot see my drawings. Can the rest of you see my drawings? Okay. Okay, I think John, something wrong with your, yeah. Okay, so for take profit level, you always want to avoid the key resistance or support area. Okay, you always want to take before. Okay, but for stop loss, you always have to, it has to always be placed after because you need the buffer. So for take profit here, just now like I've mentioned, I have entered the trade here because it has hit my 78.6 feet level, and now my short entry is in. So what I'm trying to say here, in a sense of a dynamic take profit, is that if you draw a projection, or if you draw okay, usually we use Fibonacci projection to project where prices might come to, correct? So if let's say you draw a projection here, and then it tells you that, hey, actually at a 78.6 projection level, there might be a reversal. Okay, so it aligns with your take profit before a key level, right? Because you do not want to be here, and just coincidentally, your projection tells you that you should take here. Yeah, then you should actually move your take profit slightly above. Okay, so my Fibonacci projection actually tells me to take profit here instead of here. Okay, let's see what happens. It hits exactly here at my 78.6 and does a reverse to my stop loss. Okay, so my point being, you can use other indicators to actually incorporate it to your take profit levels to make it more dynamic, right? Instead of just looking at support and resistance level. So I think Fibonacci is a good way, is a good tool to use to incorporate together with your take profit and stop loss levels, because you know it is a moving forward, or it's a forward looking tool instead of lagging, right? Lagging tool, because you have things like projection, that can let you know in advance, maybe price might reach here, right? So this is how we incorporate our Fibonacci to place a more dynamic take profit or stop loss. Okay. So stop loss, same thing. Okay, right here, entry, stop loss. I'm waiting for price to actually. Okay, my entry is here, and then I'm looking to take profit here. My stop loss is placed above. It is what we're looking for. So I entered a position. Okay, and you can see here, my Fibonacci expansion is telling me that, hey, your stop loss shouldn't be placed so close to your previous swing high, correct? So it would, what this Fibonacci does is that it helps you to define or helps you to further support and give you a more accurate place of where you should place your stop loss. So my Fibonacci tells me that, hey, my expansion, my negative 27.2% is actually slightly above where I placed previously, right? So I actually moved my stop loss right further, and you can see that, hey, it actually came here and then touch before it hits my take profit. Okay, so there are two ways. One is for your take profit level, and one is a dynamic way to place your stop loss. Okay, I will draw this again in case it's not very clear. Okay, so what I can see here is that I entered a trade. Okay, I'm gonna enter a trade once it hits here. Correct. Okay, hit my entry level. Now my question will be, where should I put my stop loss? Most people will think that stop loss should be placed here at your previous high, but what this webinar is telling you is that you should always have a buffer. But how much buffer? So this is where your Fibonacci or your other indicators come in to tell you, this is my expansion. It's telling me that, hey, my negative 27 is somewhere along this line. Okay, price tends to like to reverse off this area, okay, because this is a key level. And my 61.8% projection. Okay, so here. Yeah, my projection might be this. Okay, so my FIB projection might be this, and then my expansion is here, 27 and 61.8 projection. So this is a very key important area that prices might come to touch before it reverse. And what you should do is always place it above the important levels. Hence, you can see that the line, your stop loss, is placed slightly above your 27.2% expansion and 61.8 projection. So price actually really came here to touch before it bounced off. Okay. So this is how you actually make your stop loss more defined, more accurate, the exact points, instead of just saying that, hey, your stop loss should be placed maybe 5 pips or 1 pip above your key support or key resistance area. There are times where your FIB might not work, but it's good to give it a shot, you know, to try to spot all these important key levels before a reversal. Okay. Okay, now let's talk about risk allocation. So just now someone actually asked me what is the ideal RRI, risk to reward. Maybe you guys can let me know what is your ideal percentage per trade for risk allocation. Do you guys risk 1%, 2%, 10, 20, 50, all in? Okay, I see some answers, 2%, 1%, well, 10%, that's quite a lot. Okay, also depends on how much your pot is relative to to the percentage, right? If it's like a 10,000 or like 100,000, 10% is actually a lot. Okay. Okay. 2%, 1%. Okay. Very commonly, people will risk about, I would say, this level here. Okay. So Omar is a high risk taker. High risk, high reward, I hope. Okay. So what I want to show you guys here is roulette. So all of you guys have used or played rather roulette, right? So there's 18 red, 18 black, and 1 green. So if I give you $1,000 now to actually bet on the roulette, how much will you put on a black win? Will you guys put all in the $1,000, or would you risk how much would you put if you are given a $1,000, but you can only play one hand? Will you all in? Would you put $200, $100? Okay, $100, so about 10%. Okay, we have some other answers, right? But typically, most people will be in a range of 100 to 200. Okay, all in, yeah, because it's not your money, right? Okay, my point being, if let's say I change the roulette table, right, to 32 black, now would you change your amount that you put? Will you guys change it to all in, or will you guys actually, there's a highly likely, there's a higher chance that you might put in more than your original, be it double or triple or more. My whole point is that most people will put in more if they know that there is a higher possibility of black winning, correct? Because instead of 18 now, I have 32. Your odds are higher. Higher odds, correct? So my point is, risk allocation often depends on what is the setup like. So if you have a very, very good setup with maybe your FIB levels, FIB confluence, there's a very good Fibonacci confluence, your RSI is telling you that, hey, there's a divergence, or your stochastic is showing you that it's oversold or overbought. Okay, all this, if let's say the setup is really good, FIB confluence will give you 30%, RSI give you 30%, your stochastic or other oscillators tell you another 30%. This gives you a 90% odds of winning. So if I have a higher odds of winning, why would I not put in more, right? It's all depending on what is the setup like. Most of the time, we are waiting for a good setup before we place a trade. Okay, so risk allocation, in our opinion, is best gauged if there is a good setup on that particular trade. Okay, so the higher or the better the setup, the more we allocate a risk. Okay. Okay, so the last part to this webinar will be ideal lot sizes. Okay, so it's always depending on your account size. Okay, how many percent you are willing to risk, because it will affect the lot size that you trade often. Okay, so for example, if 50 pips stop loss, this is 50 pips, right? Stop loss, 0.1 lot, you lose $50. 1 lot, you actually lose $500. So it's always depending, you should always know how much you are willing to risk before you adjust accordingly. So I have, let's say if you guys do not know how to count, you can come to this page. Okay, for example, okay, I have calculated here. Depending on which currency pair, if you're not sure, you can use this, because our MT4, you have to state exactly how much or how many lot sizes you wanna place. So on a $10,000 account, if you are willing to risk 1%, your stop loss 30 pips. So you're risking $100, and this is the standard lot size. Okay, so if you do not know how to count your lot sizes, you can come here. Okay, if you're risking 2%, then it's a different lot size. So it's depending on what is the risk percentage, or what is the amount you are willing to take. What's your risk allocation before they show you the standard lot size. Okay. Okay. So in this example, a 50 pip stop loss. Okay, I think it's here. Okay. So 50 pip stop loss, 90 pip take profit, and 20 pip stop loss, 36 pip take profit. So which one do I make more? Let me know in the comment section. Can you all see? 90 pip take profit, 50 pip stop loss. Which one do I make more? This versus this. Let me do a quick calculation also. Okay, so which one do I make more? This one looks like it's a lot more actually, right? Based on the looks of it. Okay, I have some answers. Okay, the top, the bottom. Okay. Okay, so actually, okay, you do not need to know the lot size, because you just need to take your 90 versus 90 divided by 50 versus 36, your profit divided by your stop loss. So both give you a ratio of 1.8 to 1.8. Okay, so my point being, my point is, it's not about the amount of pips you make, correct? It's also depending on the lot size. That's why you ask. But it's not always depending on the number of pips that you actually made. I can make 1,000 pips, but actually my lot size is very big or very small. It affects your take profit, like the actual amount. Okay, so it's about the risk to reward of your trade. Okay, that's my point here. Okay, so I've come to the end of today's session, right? Do you guys have any questions for me? Okay, maybe I can go to some live charts actually. Wait, give me 1 second. Let's just see. Okay, okay, let's try. Maybe on a live chat. So maybe on a live chat I can do some examples. Okay, let's do maybe Euro. Okay, we can do Euro. Okay, so for example, if you were to, obviously we have to identify a trend, right? It's going downward. Okay, usually people will want to, okay, most people will, let's say if I come to this area here and it's in a downward descending trend, most likely I will want to place a sell order, right? A sell entry here on the second touch. Okay, so let's say if we already entered here, where would your stop loss be? Let's say this is my short entry, my sell entry. Let me know in the comment, where would you, let's say if I'm placing a sell entry here, where would you actually place your stop loss? Would it be here? Would that be your stop loss at this tip here? Or would your stop loss be here? right? Remember, we always mention if you're placing a stop loss, it should always be away from your entry. Okay, slightly above the previous resistance, neither. Okay, if it's neither, where would be ideal to place your stop loss, in your opinion? Okay, some people use pips, some people use percentages. Yes, you can actually do that. So let's try to see whether there are any confluence zone. Okay. Okay, so for example, you can see here, right? I draw my Fibonacci retracement tool, and it's telling me that, hey, there will be a reversal maybe at this level, which is actually quite an important key level because it's the overlapping resistance, right? Because there are so many levels that came here, touch, rate, 0.1, 2, 3, 4, 5, 6, then break. So this is actually a very important level that we should look out for, which also is the 50% retracement level. So it means that if price were to come back, it might touch here before a it might touch here before it bounce off, correct? So what you want to do is, if this is such a key level, your stop loss should be placed slightly above. Okay, because you do not want to be in the commotion or in the fight zone. So I will place my stop loss slightly above the 50% retracement, okay, as well as the overlapping support or resistance. Okay, so then this is just for example purposes, how you can use your other indicators to help you redefine for a more accurate stop loss or take profit placement. So if let's say my sell entry is here, I want to take profit. Usually people will tend to take profit here, correct? Because previously, if I do not have all this, okay, if I do not have all these bars, okay, I can do a replay, but it might be a bit messy. Okay, so it will be here, correct? So your take profit should be somewhere at this level, correct? But like I've mentioned, because this is a key support level, you do not want to be caught in a crossfire. So you want to take profit slightly before. I mean, it's great that it actually hit our take profit, but most times, as we know, it always misses. So I tend to place my take profit slightly above. Okay, so if this is the key resistance or key support area, I will put it slightly above. Okay, in both ways, it actually hit our take profit as well. Okay, so this is just an example of how I would place my take profit and stop loss in a more dynamic way. You can use indicators like your projection, extension, expansion. Okay. What proof do I need to give access to a VIP room? I don't think you need any proof to access the VIP, but you do need to be you do need to sign up with IronFX as a client, right? Okay, so thank you guys for tuning in today on a Wednesday. Enjoy the rest of the weekend. I will see you guys in the next session. Bye.
everyone, my name is Emily and welcome to another one of our videos. Today we'll have a look at currency carry trade. A currency carry trade is one of the most famous trading strategies in forex trading. A currency carry trade is when you buy a currency with a high interest currency against a low interest currency. Carry trading involves holding a forex trade when one currency has a higher interest rate than the other currency in the pair. The most famous carry trades involve buying currency pairs like the Australian dollar against the Japanese yen and the New Zealand dollar against the Japanese yen, because these pairs have interest rate spreads that are very high. A trader can make a profit between the difference in the interest rates of two currencies as long as the exchange rate between the currencies does not change. Many professional traders use these currency carry trades because the gains can be very big when they use leverage. However, the bigger the potential gain, the higher the risk. The currency that is exchanged in a currency carry trade transaction is known as the funding currency. A funding currency usually has a low interest rate. Traders borrow the funding currency and take short positions in the asset currency, which has a higher interest rate. The best time to get into a carry trade is when central banks are raising or considering raising interest rates. Also, these trades work well during times of low volatility since traders are willing to take on more risk. As long as the value of the currency doesn't fall, even if it doesn't move much or at all, traders will still be able to get a return. However, a period of interest rate reduction does not provide great gains in carry trades. When rates are falling, demand for currency also tends to fall and selling off the currency becomes difficult. Basically, the carry trade can result in a profit if there is no movement or an increase in interest rates. Hope you found this video useful and interesting. Thank you so much for watching us. Bye.